Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
All right, welcome back to the Weekly Trend podcast. This is David Zarling. I'm here with someone who is socially distanced from me, but still close because of technology, Ian McMillan. It's Friday the 13th, a day that everybody makes everybody nervous. The S&P 500 closed at 2711, and what a historic week we had on our hands. Lots to cover this week, Ian.
I thought we had an historic week the last couple weeks.
Yeah, it does. Yes.
And this one kind of blew that one out of the water.
Yes. Every week seems to add to the historicness.
Yeah.
And this was not an exception.
It's crazy. Oh my gosh, is this crazy?
Yep.
But here we are. Let's talk about it.
Yeah, we will survive. Obviously, topic du jour that everyone's talking about, coronavirus. Obviously, we've touched base on it, for the past few weeks here. With the market dropping the way it has, obviously they're associated with each other, and with events getting canceled everywhere. Just a tremendous environment to observe both the price behavior and the way people respond to different, whether it's the coronavirus or just different dangers in their life. We can observe it all around us. And this week in the markets was tremendous. Thursday was the worst day in the market since Black Monday in 1987.
32 years.
32 years. So pretty amazing. Today, and at the same time, today, Friday, the 13th, was the best day in the market since 2008. Mm-hmm. But it all started out with a 7% drop on Monday, with a limit down circuit breaker.
Yeah, limit down. Now, was that the first time we've actually had to use circuit breakers?
Well, I know they had them, Flash Crash 2010, they didn't operate the way they wanted them to.
Okay.
They implemented a different process in 2013. Circuit breakers were triggered, and the listeners are allowed to reach out and push back on this if I don't have this correct, but I believe both election night 2016 and Brexit in 2016, circuit breakers were used. I could be wrong about that, but that's my recollection.
Okay.
Of my head, but I know for sure they were used this week.
They were used 3 times this week, 2 to the downside. And then today, this morning, limit up 5%.
Yep. And that's a little known fact. Some people don't realize you can have a limit up, but we did this week. And for those who don't know what that means, basically they halt trading at certain predetermined percentage drops. So whether it's happening overnight in the futures market or whether it's happening in the cash market during the day, they have certain levels where when the volatility increases and you have a certain percentage drop, they halt trading for a little while and then restart. Thankfully, we did not see a 20% circuit breaker where they shut down trading for the day. Hopefully we never see one of those, but we did see a few, whether they were 5% overnight limits or 7% daily limits. We did have a couple of those this week. But really that 7% drop on Monday and an almost 10% drop yesterday, from a low point in the week in the cash market. So that actually would have been about minus 16% from last Friday. So this week's low to last week Friday was minus 16%.
Wow.
Yeah, we can all pause in silence for that one. I know S&P 500 futures were down 30% from the highs.
From the highs, yeah. 30%. Yep.
Yeah, go ahead.
I believe small caps, the Russell 2000 was down 35.
Yeah, 35% from the highs in February. Dow Jones was below its Christmas 2018 low. So if you think about that, the Dow Jones had wiped out all of the 2019 gains. You mentioned the Russell 2000. It's still lower than the Christmas 2018 lows, and it's at election 2016 price levels.
Gosh, and the poor energy sector. I don't really know where to find a high to pick from. Hasn't made many of those, but absolutely destroyed this week, even with the bounce today. I mean, and this is a signal that's gone on for years. The total complete destruction of energy stocks this week. You could argue that there's been a warning signal there for years.
Right. Well, and we've seen a relative downtrend in energy versus the S&P 500 for 4 years now. And now we have this, someone used the term like a capitulation type move, but it basically an acceleration to the downside of energy stocks. Obviously, really, in relationship to oil. And you and I, before we started this, just remembering the fact of what happened Sunday going into Monday with oil because of how intense this week was. We had forgotten that, between Sunday night and Monday morning, oil had dropped 35% and was trading as low as $27 per barrel in West Texas crude. And we've been talking about some of these price levels that had broken before, whether it's $50 on oil or even going back and talking about when 32.20 was broken on the S&P 500. So we've been in protection mode for our clients, and it's been a definite cushioning and protection
for sure.
Compared, I don't want to necessarily get into specific returns, but it's been dramatic. And so risk management has paid off using technical analysis and using support levels and honoring those.
Using relative strength. Look at the two extremes this week. You had energy down 28%. You had healthcare and technology down 7%. I mean, right. There are clues to avoid these areas. Materials, energy, these sectors didn't lead on the way up. They're not leading on the way down. They're just very weak. Yeah, and gold miners also had a pretty rough week. Usually a deemed a flight to safety, but not this week. And that's kind of something you see in a full capitulation event is even the, risk off assets get sold.
Right.
People just want to be in cash. They just want cash in their mattress.
Exactly. And right. Like, for example, you have a panic selling unfolding, and, you had this massive move in rates or treasury yields last Friday and Monday, and they then started selling bonds as well. And like you said, selling gold miners, and they're, selling gold, those types of things. So we definitely saw the selling reach across asset classes. If you think about kind of some of the credit stress, we know that a lot of the corporate bonds that are, triple C or something like that are definitely heavily tied to energy.
They are.
And, seeing energies move, as you referenced, put some stress on those. We've seen credit spreads increase pretty dramatically in those areas, and that's typically a sign of stress. And so all these things kind of go hand in hand. Downward price movements like this in sectors that are, like you talked about, like energy, that are already weak, and they just get tremendously weaker, put a lot of stress on their corporate credit as well. So we'd like to see that cool off a little bit before we get too excited about equities, even though today was a nice start.
Today was a good start. One breadth measure that we like to use is kind of the percent up and down days.
Yeah. Can you elaborate on that a little bit?
So it's kind of just it's a pretty commonly used breadth indicator among technicians, looking at what percent of stocks on the New York Stock Exchange, or you can pick really any underlying group of stocks, but typically looking at the New York Stock Exchange, what percent of stocks were up or down for the day. We had quite a few 90% days this week. Something we also saw back in 2011. In fact, I believe there were
Several back-to-back up and down.
either 9 straight minimum 80% days in 2011. And I think 7 of those 9 were 90% days.
And they were like back-to-back where you're saying like one day
Don't
you'd be
quote
80%
me on
up.
that. Don't quote me on that. Go to Walter Deemer's Twitter page. He's the specialist on that. That's who we follow for things like that. But typically, you can negate a 90% down day with either a 90% update or 2 back-to-back 80% updates.
Right. And 2011 definitely was a wide range sideways move, and you'd have these 80% up days followed by 80% but down days, like you said, back to back. The quantity, like you said, we don't have to be exact on it. We just, as being market historians, that those type of environments do exist. That was a potential. That was even a potential we were talking about going into last Friday.
It was.
But obviously that thesis was negated with the gap down on Monday, which using technical analysis, we were able to avoid that for our clients. And then maybe we established, continued selling actually throughout the week. But now we're looking for those type of, for example, today, like you said, we had almost a 90% upside participation day. It would be great to see a follow through to that on Monday. We'll find out.
Yes, we do need some follow through. We've had great starts a couple times the last, maybe 2 or 3 times over the last couple of weeks, and there was never any follow through.
Right. They would have a nice participation upside day, and then immediately followed by a downside participation day. So yeah, we definitely want to see follow through on Monday. With about a couple minutes left in the client portion here, I know we talked about the historicness of this past week, how we were able to protect accounts from this. Is there anything that you want to touch base on before we move to the next portion, the extended part of the podcast?
I'd say, obviously being a part of the adaptive process and being able to cushion client accounts, not just this week, but going back 2-3 weeks ago, really back to the that Monday morning gap down on February 25th, I believe it was, where that was a clear kind of change in behavior that we had.
Right.
And I know that there's a lot of clients out there that have friends and family with nest eggs that probably are not a part of a firm that believes in active management, probably much more buy and hold types of portfolio management. And I'm sure that they had very stressful weeks. So I'm just glad, with all the thank you emails we got from clients, just glad that we're helping people sleep at night through all of this.
Absolutely. I mean, there's
a lot to be said for that, for mental health. Right.
And that's, this is why we do what we do. If you want to buy and hold and ride this out in your 20s and 30s, absolutely. If your time horizon's long, obviously you don't want to panic in these situations and be selling down here. But there's a reason why we use adaptive management, and it's for times like these where we're able to protect client accounts. And I know, like you said, we've received some emails about just being able to sleep at night, and that's worthwhile too. So we're going to continue to do that. We continue to have price levels identified, predetermined going forward as far as what we'd like to see recaptured to the upside. Just for you, if you're following at home, for us, before we head to the extended portion, we've had a lot of downside volatility. That's quite obvious. We've been able to protect from that. Next week, we want to see Monday have follow through to the upside. We want to see the S&P 500 recapture 2740. Things like the Dow Jones capture 23.7 and Russell 2000 recapture 125. But we'll take it day by day as we have been.
2740 will be another first step.
Yeah, that would be tremendous.
2820 after that.
Yep, absolutely. And
then probably 3025 after that, which brings us back to, and I can't believe I'm saying this, the late October breakout.
Right.
I can't believe we had strayed that far.
Right. Well, it's the fastest 20%, and now it actually was 30%.
It's 30%, yeah.
Fastest, and it cut the record. And so the second fastest correction like this
was 38 days
in 1896.
Mm-hmm.
So, we did it, I think, in 17 days. So pretty epic.
17 or 18.
Yeah. So that's why we're adaptive. We'll take it day by day. It helped us cushion on the way down. It can help us participate on the way back up if that's what we get.
Yes.
And that's what we'll do. I know a lot of us here, just to us, when markets are rising, that's a better type of environment to be involved in. We can protect from down markets, upside markets. I think for the overall, our friends and family and those who might not be clients, because we completely understand the pain that people are in with this. And so we don't want to make light of it. And we're just happy that we've been able to protect client accounts in this environment, and we'll continue to do so. So that concludes our podcast here. You can stay tuned after the break here for more in depth if you'd like, but we appreciate you guys listening and the great feedback that you've provided. We'll continue to work on your guys' behalf. Thanks for listening.
Have a great weekend.
All right, Ian, heading into the extended, more in-depth version here. We covered a lot of historicness in the first segment. And now, seeing the, I think we talked about how big of a drop Monday and Thursday being the biggest drop we've seen since 1987. Now Friday, being the largest move up since 2008. What are the things we're now looking for to confirm that there's actual buyers here?
Well, obviously you want to see price itself move higher and see a continuation day on Monday of what we saw. I think seeing VIX back below 50 is a good start.
For sure.
We had mentioned we peaked out around 77, 78 earlier this week, finished the week at 57, which is still a pretty extreme reading.
Right.
So we're still going into Monday expecting a 3 to 4% opening swing.
Right. We don't get to, with a VIX that high, we don't get to have, we don't get to be surprised by large gaps and wide ranges. I think you pointed out, before in one of our conversations, a VIX at 77 divided by 16, and that's 4.8.
Mm-hmm.
That's a range of 4.8%. And so those are the types of moves we can expect. You talked a little bit about follow through on Monday with participation. Can you elaborate a little bit more on that? What do you mean by that?
Yeah, I think going back to the kind of one of the breadth indicators we had mentioned in the client section, specifically the percent of stocks up for the day. Definitely want to see at least another 80% up day.
Right, because we had 89% today on Friday, and now you're saying we want to see another green
Mm-hmm.
day with 80% or more participation to confirm.
And it's funny you bring that up. So we say 80% or 89% up day on Friday. And we like to talk about seeing another, 2 back-to-back 80% days. Is there a difference between 89 and 90? Probably not.
Yeah, it's pretty de minimis. I mean, some
yeah.
would say a 90% up day is a pretty significant up day.
I think Treasury's coming back down is a good sign.
Right.
Obviously, they were quite extended. I think you want to see some of these relationships, intermarket relationships, turn around. I'd like to see staples versus discretionary turnaround. Staples have been outperforming, obviously, since this move started, and are really still kind of breaking out of a base. I need to see that reverse. Were you in theory?
Right.
Who knows? We could have a nice bull market where staples lead. Nothing out of the question here, but it would just be one more signal in favor of the bulls.
For sure. I think, for me, some of the credit tightening we saw in the past weeks here with, corporate municipal bonds, I'd like to see those showing some liquidity. I know we had a situation this week where we were getting out of a product and having trouble getting a price back. And that was the type of things that were happening in 2008 when credit was tight, was getting a quality price back once you were going into the market. Thankfully, it worked out. But the next day, that instrument was down quite a bit. And, seeing things like CCC bonds, their yields the yield spreads are just have been moving very quickly to the upside, which is obviously correlated to the things you've been talking about with energy.
And I think I mean, you can see a lot of these odd pricing and spreads on charts too. I believe there was an issue earlier this week with iGov is an ETF, an international treasury bond, and it had actually priced at $200,000 a share for about 15 minutes. Now, obviously, the exchanges got that all squared away, but it's a lot of these participants that come in with market orders are really just unfortunately getting hit in some of these places.
Right. If you're not coming in and going about it in a diligent way based on the size of your trade, it can really hurt you on the spread that you take in the when you get in or when you get out. And we saw it kind of across, like a ETF like LQD. They had issues this week as far as what was going on underneath the surface. Even some of the municipal bond funds, those type of things. So we want to see that come back in. I think euro dollars, that's a place where it's a risk off instrument that people like to flee to in times of stress. That's really taken off, and like to see that cool off. You mentioned, VIX continue to move down. So some of these ranges can cool off a little bit. I think a big event this week was Apple holding 255.
Absolutely.
That was an important level going back to December of last year. And admittedly, when that did not hold on Thursday, there was, some trepidation as far as how Friday was going to look. But they reclaimed it during the day, and overnight they lost it, and then they reclaimed it during the day, and that's a good thing.
And the same with Microsoft at 150, lost and reclaimed on Friday, closed at 158, a good sign. Semiconductors continue to outperform. Tech in general continues to outperform. So again, even through this massive sell-off we've had, value has really taken the brunt of it.
Oh yeah, for sure.
Financials and energy, tech, healthcare, holding up quite well. A lot of this felt, and value, kind of what we had discussed, again, in the client section of, energy stocks got hit really hard this week. But you could say that there's been warning signals for years. Same with value. Growth has outperformed value for the last 3 or 4 years. So to see value stocks be kind of the main, I don't know if they're the cause, I don't know if they're the victim, but certainly hit the hardest this week. Again,
Right.
not a surprise. Same with small caps.
Right. You've been a big proponent in pointing out that as long as they participate, they don't have to outperform.
No.
As long as small caps are, in some way participating, and I think we can all agree that the last 3 weeks, participation has been zero. There's been no buying going on in that area.
No, and they were the laggard today, and I'm okay with that. They were still up 7%.
Right. And I think, we've talked about important levels, and really the Russell 2000, if we want to talk small caps, needs to reclaim 125. That is a huge, huge level that is so important before we can get really excited about this having any type of extension to the upside. And some of the things that, we're always game planning, right? And so let's see if we can touch base on potential outcomes from this point forward. So what are some options for outcomes? As far as some people talk about like a V bottom or bear market
rally. Yeah, we could have another
things.
V bottom similar to 2018. There's a lot of mixed opinions out there on what type of bottoming process we will have. A lot, given the similarities in the VIX and volatility to 2011 and 2015, a lot of people seem to be thinking we'll have more of a W type of bottom where we come back and test these recent lows that we made on Thursday or even undercut them. And a lot of that coming on the heels also of 2018 being a V bottom, and a lot of people kind of thinking that there's just absolutely no way we could have that type of extreme V bottom again. So then the contrarian in you leans towards, do we have back-to-back V bottoms? What is going to surprise people the most? Right.
And you could have, before we broke down the prior range heading into last Friday, you still had a thesis of a 2011 type bottoming process in play, right? So when we game plan, we just think of different theses, and the 2011 thesis was still in play at that point until the breakdown. And that's where you have this, some might call that a W bottom or, a double bottom. Some might call that a triple bottom, depending on how you look at it, where you have this back and forth range. You might have an 80% up day one day, followed by an 80% down day, and it just goes back and forth. We could also have, I know we're talking about bottoms, we could also have a gap down on Monday.
Yeah, there's absolutely no solid proof that we have reached a bottom. Friday was simply a start in the right direction, but we've done it before during this downtrend.
Right. They did the prior Friday. They had bought into the
beautiful close.
Yeah, bought into the close, and then they took it limit down Monday. While we like the idea of there being a bottom somewhere here, just because we have such extreme sentiment readings, panic type readings, that some type of rebound. And again, we might not know if it was a bottom until weeks or months later, just simply because it could be. We know that bear market rallies are ferocious. You could have quote unquote a V bottom, but we don't know anything until we clear the all-time highs on whether that was a bottom.
Exactly. There's so much supply to navigate through. A lot of price action on the left side of the charts now. This is why all-time highs are much easier to trade. It's a lot to navigate through. It's going to be an interesting journey.
Right. Should we walk through some of those potential levels that we're looking at, like, for example, I know on Friday, what was nice is that price reclaimed 2,600, let's call it, 2,590, 2,600. These are lows that go back to 2018 in the S&P 500. So that's like a good first step.
Yeah.
But we still have, something like 2,750 or 2,740 ahead of us to get above.
Yeah, I think getting below or back above, like you said, the July 19 lows, 2,740, 2,730, the August lows at 2,820. Your next step through that is going back to the late October breakout at 3020, 3025. So a lot of steps need to be taken to prove we are back on the right track.
Right. And even the Dow Jones has to reclaim, something like 23.5 or 23.7. It exceeded the December 2018 lows and then reclaimed it on Friday, and we'll see what they do with it from here. But like you said, there's a lot to work through, and it's a step-by-step process. It's not just something that's going to necessarily happen overnight. And so that's why you manage day by day, and you take those price levels and you see how supply and demand interact at those levels and adjust accordingly. I think we all agree we'd feel better if, something like the Dow Jones was above 26.7. That was a place where highs had been established before and broke down. So those are some good levels for those at home. You don't be afraid to write some of those things down if you're following along, because I know we've provided levels like that in the past, and they're important to remember. Anything else that we want to cover here before we wrap up this portion of the podcast?
One thing I'd like to say, and obviously we experience this a lot being in the RIA wealth management world. For those that are experiencing some stress and angst during this time, don't wait until these types of periods happen in the market to look for advice and planning. You've got to have a game plan. We talk about this all the time on the investment side, but it's really true in your whole financial picture. You've got to have a game plan going into this. We get lots of calls and emails from non-clients during times like this, looking for guidance. And at this point, after a 30% drawdown, I hate to say it, but it is almost too late to make any adjustments.
Right. And at that point, while painful, and we acknowledge that, let it be a reminder of markets being inefficient. And so, as you alluded to, the whole financial picture, let it be something that as we rebound, as the market comes back, whenever that is, that maybe some planning, maybe some adaptive management makes sense for you. And, I think that's a valid point. Don't wait until the panic is here or till the correction is here. Prepare for the storm before it arrives. It doesn't pay to necessarily put up plywood as the hurricane is here. And I don't mean that to sound callous or anything like that. It's just, part of the financial planning process is always game planning and looking for scenarios to manage risk through. So good point there.
Well, and I say that because I know that, there are so many people that had no one to hold their hand through this. And,
right.
Really felt the pain all the way down. No communication, no one reaching out to tell them that they've got things under control.
Right. It's hard. That can feel very lonely, even though many people are going through it. Thankfully not our clients, but there are many people in our lives that we need to acknowledge that this is painful. This is not, markets are not your friend. They're, I always say that if you want a friend, get a dog. Markets are not your friend.
They are not. I think that quicker moves to the upside and the downside will become more common as time goes on. I'm not saying where I'm expecting another 30% drawdown in a month, but I do think just given the environment we're in, markets move much, much quicker. And to the point where, no, your average investor cannot react to things like this.
Right, because they have a life to live. If they're in retirement or they're at work, they can't be managing downside risk by taking an inversely correlated product into the market to cushion. And
then saying they'll check up on it a couple days later.
Right. It moves too fast. I mean, and then you think about, if you're pulling out of if you're taking distributions out of your account to fund your retirement, and we've had 2 corrections of 20% or greater in the past 2 years, that's a very difficult, because it's working against your dollar cost averaging, right? Rather than putting money in.
I mean, you're selling
at
1.5 times as many shares for the same dollar amount.
Right. So that there is a place in a portfolio for adaptive, protective management that still, captures reward on the upside. Don't get me wrong there, but it's very hard. I don't know everything about my car. My car gets me where I need to go, but I do trust my mechanics to take care of it. Or I trust the pilot to get me to my destination. I don't have to know everything about the plane to get me there. And that's what we do for our clients is they can hop on board and we can make sure we take good care of them. And sometimes we even land the plane and we don't get involved with the storms that are going on around us. And so that, your point is a good one. If you are in pain through this, markets do come back. They tend to. We don't know where the bottom is in all of this, but an important thing not to do is panic at this point. If you've been part of the full downside, don't panic, don't change at this point. But good point there, Ian. I don't know if we touched on oil and rates in combination.
Oil and rates, yeah. Gosh, I think the 10-year hit a low of 0.4% this week, yield. Closed the week at spot 95% yield, still incredibly low, but well off the extremes. Obviously, those have hurt banks. Really need to see rates go higher for banks to begin to show some life, and thus for financials as a whole. There's other parts of financials, but really you need to see the strength there from the big banks, JP Morgan, Bank of America, Citi.
Exactly. And it's interesting because we may or may not have touched on this previously in this podcast, but Monday feels like it was a very long time ago, and sometimes we forget the tremendous move in treasuries between Friday and Monday, as well as oil dropping 35% Sunday night into Monday morning. Just a tremendously historic week. If you're out there and you're managing through this for your own clients or for your own account or any of those things, it pays to take notes during this time. Just note how the market basically performed each day would be a simple thing like that. And maybe even how the media is portraying it. And just take note of, because I don't know, Ian, that we'll ever see a week like this in our lifetime again. Now, the market doesn't care what I think. It can be historic again next week. And we don't know which direction historic
it could be.
But like you said, the past 3 weeks they've all had some historicness to them. But this week was this is one that will go in textbooks.
Absolutely. Just it will be something that generations hear about for decades, just as I have heard about 1987 for decades.
Right.
My entire career. People
Absolutely.
that have come before me, that, they survived it. We will survive. I think weeks like this go back, and I think they reinforce that buy and hold just is not the answer.
Right. Buying and holding, especially when you're,
if you're close to retirement.
Right. Near and in retirement, very difficult. I would even say not in your best interest. I understand the arguments for buy and hold when you're in your 20s and 30s and your dollar cost averaging in. You got long time horizon.
And what if you had retired on January 1st of this year?
Right.
And your retirement was just cutting, cutting a third, cut by and a quarter.
Right. Absolutely. And
so that's a hard way to start out. If you've planned for 20 years of retirement savings right off the bat.
Right. So, that's why we'll stay diligent and disciplined for our clients, both on the way down and on the way back up. Whenever the way back up is, maybe it started on Friday, maybe it didn't. We're going to just continue to stay disciplined to price. Ian, you should feel proud for having gone through a week like this. We managed it successfully for our clients. It wasn't easy. I know how exhausting it is. So I appreciate what the adaptive team did this week. Tremendous effort. And I know our clients have expressed their appreciation as well. I think, we've had a couple clients say they appreciate that they can sleep at night.
Well, and I'd say not even this week, but going back to late February.
Right. Right. For sure. So reducing exposure even back that far. But even, going through a week like this with little to no exposure has definitely been a benefit.
And a shout out to Kevin Ferrari as well.
Oh man, for sure.
Who did an awesome job this week.
Kevin helps build the trades that we execute. He's always on point. He does the editing for this podcast, and he's the man. Like he is awesome. So definite.
A good little technical analyst too.
Oh,
brings lots of ideas to the table.
He's an up and comer.
He definitely is.
Yep. Great stuff.
Extremely grateful to have someone like Kevin on our team. Was not phased at all, and we asked him to do a lot. I mean, we have for the last 3 weeks.
Yep. Yeah.
That kid has.
He's always got, for lack of a better way, don't be offended when I say something like this. He's always got a bullet in the chamber. He's ready to go. He's ready for.
He knows what we're going to ask for.
Right. He knows what we need before we even ask for it. If you want to think about being in an operating room and someone being by your side that knows the instrument you need when you need it, he's on it. And so it's a pleasure to work with both of you.
And
guys.
That's a huge, because markets like this move so fast, you have to be timely.
Absolutely. You can't, an entry point makes or breaks the whole trade. You make the money when you buy and when you sell, but it depends on where you buy. So, definitely shout out to him and shout out to you, Ian. You guys do tremendous work, and so I appreciate it. We're accomplishing some things that wouldn't necessarily been able to have been accomplished, just 2 years ago, based on limitations and resources. But now we have the resources to do that, and happy that it's in place now in such a historic market, and that we're able to protect client accounts and participate in markets when they make sense. So, thanks for highlighting that. Thanks for another great week. Anything else before we close this up?
I think that's it from my end. Again, everyone, do what's best for your family. Stay safe, stay clean. We're all trying to make this through it without sports. So
yes, it is. Isn't that interesting that we get to be, somewhat quarantined here and we don't get to watch our favorite sports, but
no Masters, no March Madness.
Right. Again, one for the history books, right? It's going to be something that our children will remember. It's something you can talk about with your son as he grows up. And really, it's a great opportunity to reconnect with our families. A lot of us have busy lives, and this might be an opportunity to slow down and kind of enjoy some of the smaller things.
Yeah.
And so, yeah, please be safe out there. Abundance of caution. We also understand that, there might be some twinges of panic or hysteria as portrayed by the media. Just if you find yourself getting anxious, maybe turn off the TV, maybe not read a newspaper, find something else.
Yeah.
We don't always have to know. The news doesn't always know exactly what's going on either. And so they can be a little bit sensational, and that can sometimes cause anxiousness. So just turn it off. You don't need to listen to that. So again, thank you, Ian. Another great week. Thank you for those who listen and for the feedback that you provide. We appreciate it. And we'll do this again next Friday.
All right. Take care.